Hey guys, Caleb Patton with Broker Brothers Mortgage, talking to you about variable income. How your income is calculated matters immensely in the mortgage underwriting stage of things, and most folks really misunderstand this. There's a variety of different ways that we all make money for a living, and many of them are not consistent. Some of the more easy to calculate types of income would just be your W 2 hourly or salary individual. Now, if you're salary, this is ideal. This is the easiest for you to understand. And the reason this matters is this is going to change how much of a home you're easily or not easily going to be able to qualify for. So sometimes it's good for you to know how this works. Now, if you're hourly and it's consistently 40 hours a week, once again, that's an easy to calculate non-variable source of income. But there are many variable sources of income, beginning with an hourly employee who is not consistently getting 40 hours a week. Even full-time nurses sometimes, right? In the medical profession, it's often 12 hours a week shifts, 3 days a week. Well, that's 36 hours a week. And according to many guidelines, that may not be what's considered a consistent full-time non-variable source of income. If your source of income is now considered variable because you are not a consistent 40-hour-a-week employee, or you have other types of pay like bonus, commission, self-employed, or otherwise, shift differential sometimes. There's many different forms. Now this is often going to be calculated on a 2-year average scale. You have to have an average monthly income to be able to come up with a debt-to-income ratio, which is just one of the different qualifications used amongst many, like credit score and others, to know if you qualify. But how can you come up with an average monthly income if the monthly income is an average every month? Well, that's where you have to take it out over a 2-year period of time many times, sometimes as little as 1 year, depending on the program and types, which is why brokers are better. We often have those options and that flexibility. But in general, for our purposes today, we'd say you take it out over a 2-year period of time. And as long as it's increasing year over year, then you would average it out over those 2 years. There's your monthly average income for variable income. There are nuances to this, but these are the basics on how to understand and appreciate variable income.